The retail trader mania has come back into the news as Congress attempts to pretend that they're on top of it all. They'll blame a few people, maybe a slap on the wrist here or there, and yet it won't be possible to ever acknowledge that the Fed has enabled such speculation. The reason why people aren't saving money in their bank accounts, that they aren't taking a more cautious approach to their investment strategy, is because the cash is devaluing so fast, you have to put it where you're going to get the most bang for your buck. Unfortunately, sometimes you lose a pair of underpants in the process. You came here for the truth, so let me unveil that for you. Today we are going to talk about how dangerously close to collapse the financial system was, and people didn't even realize really what was going on. They thought, well, you know what, we've got a few stocks over here, some high flyers, GameStop and AMC and so on. It's got nothing to do with me because I've got 7 shares of Amazon. But people don't realize how interconnected the market is and actually how fragile it has become. The fragility has been created, of course, by the policies that they've put in place, they being the central bankers, as well as what the government has done. They've enabled this, and it's been going on a long time. If they try to put protections in place, like during the financial crisis, after the financial crisis, I should say, they start to reverse those as the years go on because they say, hey, the financial system is really healthy. Now we can take this away so that it can grow even further. We want to get rid of any and all regulation that's put there to ensure that these type of companies don't completely take over everything. We're talking about these multinational conglomerates and so on. So they don't regulate that, but they regulate the average individual and they tax them to oblivion. We're going to look at some information today. We're going to talk about my girl Janet Yellen, and we're going to look at so many facts today. I mean, I've got details up and down. So let's take a look. I wanted to start with this. You've been seeing the speculation going on, and what I'm talking about here in part is to do with SPACs. I know you know what these are all about, but check this out. Just another SPAC files for US IPO. Really, that's the name. It's literally called just another acquisition corp. I mean, they're not even creative anymore. And the funny thing is that we have these type of things happening and people just pour their money in because they know that it's going to create a buzz around it and money will flow in, and hopefully, like many others, it's going to go up in value. 30 trading days into the year, 145 new special purpose acquisition companies or SPACs have gone public in the US, an average of 4.8 per day. At this pace, it will take less than a month for the volume to surpass last year's $83 billion, which is more than the previous decade combined. Unbelievable, but this is what's going on. Does it mean that the SPAC is bad? Does it mean that the companies are not good? Absolutely not. That has nothing to do with it. The fact is that people are simply throwing their money anywhere and everywhere to try to get some returns. And when you have that happen, you see things like the dot-com bubble, like the tulip mania, like all of the different, South Sea bubble and everything else, that people just go in and chase it higher, and higher, and it keeps going higher. And the higher it goes, the more people get sucked into it, and the less people that are left sitting on the sidelines, and more, and then something happens. Who knows what that could be? Every single event tends to be different, and you see it all tumble down. And then you look back in the pages of history after it collapses, and we look back and say, oh my goodness, how did they not see that happening? But that's the way it works. You can't see it when you're inside. It's always in the pages of history. Everything looks so clear. Here, this is kind of an overview of what's been going on as Congress is grilling a few people in with the GameStop fiasco, and they're trying to get the head trader there and make sure that he wasn't responsible for it, and now he's getting sued and so on. There's little consensus about what went wrong, if anything, during the trading mania that drove a group of meme stocks to meteoric heights, and those tensions could animate today's GameStop-centered congressional hearing. So at the end of this, we're going to see what's actually coming out of it. Will there be anything? A week, 2 weeks, a month, whatever it might be. But ultimately, when you have something like this, usually they burn one or two people. The actual system itself isn't being acknowledged for the actual reason why things like this do happen. You do not have something as crazy as it was and as fragile as it could be if there were actual policies put in place. But that doesn't work like that, of course. Now, you know what happened. I mean, I'm not going to go over the whole thing, but this right here would give you sort of a breakdown of what's going on if you haven't been paying attention. But I think I want to move on to the next one. Interactive Brokers Chair says financial system came dangerously close to failure during the GameStop mania. That's bold, if I must say, because you don't hear that type of talk from anybody at this level. We have come dangerously close to the collapse of the entire system. There's a hole in the system that we immediately have to stop. So if you notice what had gone on during the financial crisis, it was pretty interesting because you had all of these different points. And if you had read the books or, looked at all of the different things that were happening as it was happening, you might have had something like an AIG, an insurance company, and you have, let's say, the traders that are involved, and you look at the retail banks, and then you see what happened in the actual housing market, so let's say that, and then you have the derivatives that are connected in with it, and so on. All of these things, they trade money and it goes in between each other, and you've got trades and bets that are taking place against one another and so on, and this is all moving around in different directions. Anyway, you get the point, right? But at some point, if you have a failure in any one of these, now this whole mess, this maze, has all been turned upside down. That, of course, is always covered up temporarily by the big old Fed here. And they simply say, don't worry, we're going to take care of everything. And they try and basically inject themselves into one way or another. But really what they're doing is taking a piece off. They take that piece off and they bring it back home. Their balance sheet is growing, and the actions that they are taking is actually just creating a moral hazard, because instead of allowing that to repair itself, which would be really hard in some cases, you've got companies that would go under, and of course their assets will be consumed by other companies. A lot of the people would be spared their jobs actually in this case. But what they do instead, see, people think, let me just interject this quickly. They think that, okay, if this particular financial institution suddenly breaks down, then all those people at that company are going to lose their job. Instead, what they do is they bail it out. What happens after is the austerity. Not just countries have austerity, but companies too. So now they're in big trouble. They fire a whole bunch of people. They get rid of them. Okay, sure, call it what you want. Call it they let go a bunch of people. Whatever, doesn't matter. In this case here, you're going to have the same basic situation where the assets get split up and maybe certain departments are kept because that next company they're going to, they need them. And so you may have a lot of people that are spared their jobs in that case instead of just getting rid of everybody. It doesn't work like that. You could see the historical examples. Not necessarily saying that it can't, but that's the way it usually works, because the assets, and then you need workers to work on those assets, they are all going to be needed by somebody. Somebody's going to take them. Somebody's going to like that. Okay, let's move on to the next one. Hedge funds did very well in 2020 and even into 2021. You can see right here, Citadel Securities reaps record $6.7 billion on volatility. Firm brought in 6.7 of net trading revenue in to 2020. Market maker seeks loan for debt repayment and trading capacity. I don't know what's going to happen with any of these hedge funds and how ultimately their livelihoods have been affected by this, because this is something that can go on many times. The retail traders can get back in the boards, start moving things around again, and you have a company like Citadel which will hop on the back of those traders and in fact make more and more money. It doesn't necessarily have to be the ones on Robinhood and so on. It could be anywhere, but certainly because of the way the system works and the payments that they're given over to Robinhood making this all happen, it is certainly one company that they have been able to benefit from. If you found this video informative, hit that thumbs up button. When you do, you're supporting me. I want to thank you for that. Simply by clicking that one button, you're going to help me out. Thank you. If you want to learn about e-commerce for free, I have an entire course. Breaks the whole thing down. There's over 9,000 people in it for free at the AmazonGPS.com. Have you seen my 2 books at all? If not, you definitely want to check it out because you can actually flip through the pages of them at the link in the description. If you haven't seen this video yet, you definitely want to click it, and I'll see you there.